Good morning and welcome to the last trading day in January. We have made it to the end of the first month of 2026. It's not looking like it's going to be a positive day. Stocks are under pressure in the pre-market. The S&P is down 0.5, NASDAQ down 0.67. Yesterday was a rough day, especially for Microsoft and software stocks. They got sold off quite a bit. Looks like oil is taking a day off. Gold, what is gold doing? Gold has been going higher and higher, and silver's just been on an incredible rise. But it looks like everything's turning down. Interesting to see. And what we're going to do on the live stream, we're going to go over some stocks that announced like Apple and Chevron. We'll analyze them fundamentally, take a look at the charts. I am joined by my colleague, Daryl. How you doing this morning, Daryl?
Doing great this morning, Victor. Good to see you. Hello, everyone.
Great to see you. And so far, how's January looking for you? Any thoughts on how the month's gone?
I was expecting some volatility through the first half of this year, so I'm not too terribly surprised by all of this. My portfolios are up. We'll see how they do at the end of the month, but they should be up, so hasn't been too terribly bad.
Good to hear. This month, I'm getting out of the gate a little slow. I think my investments in software have been the main reason why my portfolio is not up to or off to a great start. Some stocks that are bright spots, of course, Meta really got it done this week, got it done with their earnings, and that's one of my big holdings. Google's continued to be a good one. But I think this space here is going to take some patience, but I think there's going to be some value long term. As I think about the last 5 years, really, I'm going to go 7 years. So investing, right, is it's almost like a movie that's playing out real time. We had COVID, and COVID, man, I'm going to call it a strange time. I couldn't believe that we were going to shut the world down. I remember when we heard about this pandemic, I was in disbelief. I actually traveled probably a week after it got announced, like, hey, we got this pandemic. And I was beginning to see the masks and everything. So the world was shut down. Everybody's working from home. Like at that time, my sons had one in high school, one in college. They were hunkering down at home. And the stock market crashed. And strange time. I didn't sell any stocks. And we bounced back. And so that era was all about like what is going to rally coming out of COVID, what's going to be a good stock that's taking advantage of everything distance, Zoom, learning online, and all that good stuff, healthcare online, and so forth. And fast forward, we got to the AI trade. It's been an incredible trade for the last 3 years. It continues to be incredible. If you look at like storage, I guess there's a scarcity in storage. So SanDisk and all these other storage companies are flourishing. But the party has to end. Stocks get too expensive. They get too euphoric and they have to sell off. So like you, I think your comment was you wouldn't be surprised if we had a little bit of volatility in early 2026. And I'm right there with you.
Yeah.
It's we tend to have, it's almost like the higher stock prices are not necessarily the reason why we would have a sell-off, but as soon as you get a good storyline or a good news item, there's a lot of selling. People are like more ready to sell. So I could see us getting corrected here in the first half of 2026. Now, I do have a good pile of cash that I've been accumulating by selling some stocks. And I'm glad I have that pile of cash, especially on red days. And I'm being patient. I'm not jumping in head first on buys. I'm just patiently buying into some stocks that I do want to own. I've been selling out of a couple of stocks and continue to have a good balance of cash. Not a majority of it. I have maybe about 3 to 4% cash right now. So I don't like carrying too much cash. Like, oh yeah, I'm 50% cash. No, that isn't me. What are your thoughts? What's like a good cash balance for you?
It varies because I'm in retirement. I have to have some cash available just to live on. So I manage my cash level basically for distributions. I don't want to be forced to sell any stocks for a distribution. So I only withdraw cash. So I always make sure I have cash and keep that level where I need it. That can also include, like I have some in like SGov, which is short-term treasuries. I don't really have to worry about the price fluctuating too much, but it pays out a monthly dividend. So it's not all just sitting in a cash account. It's actually some of it's invested in things that are stable, but I could sell off without any worries. We could probably do a whole class on that at some point. I've had to really learn that over the last 5 or 6 years on how to manage that when you're actually in distribution mode. It becomes very important.
Yeah, I agree with you. And what I would add on to it is, learning how to invest or have a portion of your investment in bonds
Yep.
is a good skill. I have about 12% in bonds plus my cash, so call it 16% overall. And these positions, if the stock market sells off, they tend to go higher. Not a lot, but they tend to go higher. And I could liquidate those. Those are
Yep.
very liquidatable.
Yep.
And so that's part of my game is, okay, I've put in some sweat equity into knowing how to invest in bonds. Now I could use that as kind of the safety net or the place where I could grab new fresh cash. If we had like a real bad sell off, like holy smokes, man, we've got stocks that are really sold off. Just as an example, Google gets sold off by 30%. Well, I got to jump into that. I could go get some cash there and then replenish it. I've been buying into more bonds. I buy through a couple of ETFs. One's a long-term bond ETF, one's an intermediate bond ETF. And right now I'm not in a short-term bond ETF. I just kind of carry it on my cash balance and I get paid a decent rate.
Yep.
So that's another thing to consider, I guess, for older investors, that you are trying to manage a household budget. Maybe there's some expenses coming up. You need to buy a car, remodel a kitchen, or whatever's coming up. You can manage your cash flow. All right, good stuff. So looking at the big names, NVIDIA is getting it done. 49% rate of appreciation for the 1 year. It was up yesterday. Google getting it done and then some, 73% rate of appreciation. Apple had really good earnings. We're going to talk about Apple. I was impressed with the earnings, but the market isn't. It's like, whoa, stock market. It's a down day, but I don't know that that's the complete reason why the stock's not rallying. So I'd like to try to figure out why. The earnings look good, and they're underperforming the S&P. They're still a major cap. Microsoft, boy, I think Microsoft's going to, before their next earnings, is going to announce some type of okay, we hear you, stock market. We hear you, investing community. We're going to slow our investment in the data center. We heard you. You took our stock down 10%, which was like 350 plus $billion of capital leaving the Microsoft stock. That's people saying, okay, I'm cashing. And you guys don't get it. You got to make money. You got to make cash flow. And their earnings, again, I'm going to go back to it. I'm going to listen to the Apple earnings later today. And, these executives, these leaders, they obviously are really intelligent, talented communicators. The Microsoft earnings call was anything but that. It was like, geez, guys, I felt like I was at a train station listening to all the arriving and departing trains, like just a bunch of data coming at me. They didn't have a succinct strategy. Like, here are the three things that if we get these three things done, we're gonna exceed, we're gonna add value to the shareholder and so forth. So I would say that was part of my just thought process. Meta did have a very clear strategy. Like, this is where we're going. This is how we're going to do it. Here's our performance. The performance was excellent. So good job there. I'm looking forward to Amazon's earnings and Google's earnings next week. Those are going to be huge, humongous. I think those two earnings are going to set the table for the next couple months. And if they, if let's just imagine Google comes out and like Microsoft says, hey, we're spending a lot of money on that data center, or their profitability goes down, their cash flow goes down. And it's almost like, hey, you're looking and smelling like Microsoft stock and it gets sold off harshly. That'll be interesting. We'll see. We'll see what they announce. All right. Other than that, Tesla traded down after their earnings. That was another company that announced. And I noticed that the financial space really caught a nice bid. Some of the stocks, big banks, MasterCard, Visa, had a really good day. All right. So we've got a good number of people on. Good morning, everybody. Thanks for joining us. We are going to look at some stocks. We're going to start with Apple. Try to figure out what is the market. Well, it looks like the market is buying into Apple a little bit. We're about 17 minutes from the market opening. It's a big cap, 3.8 trillion. And the revenue for the full year went up 10%, but in the quarter, it went up 15.6. That's a really good growth rate for a gigantic business. That's a big, big amount of revenue. iPhone sales were really good. Now, the one comment I heard was that their expenses were higher than what the investing community would have liked.
You're talking about their inputs?
I'm not down to that detail. I just heard that storyline.
Yeah, I think it was the inputs into their manufacturing processes are higher, so memory prices are higher, and there are some tariff related impacts, so their input costs were higher. And I heard that next year, when they could or maybe should pass those along, that they may hold their prices the same and it could hit their margins.
So I am seeing exactly what you said is showing up right here. Cost of revenue, that's your cost of goods sold. Cost of goods sold is your prime cost. If you're an accountant out there, you know what I'm talking about. That's your direct material, your direct labor, and your direct overhead. And that number did jump. You see how it jumped from 54 to 74.
Sure,
that's a pretty good jump. I get it. It costs more, but should that be a surprise to me? No. Like, of course, memory is more expensive. Look at where memory prices are. Is Apple going to stop using memory? No. Got to use it. So I understand both sides. The investing community is like, you know, I think irrationally thinking, well, we're going to penalize you for increased cost. Well, what's Apple going to do? They got to use memory. Very, very good color there, Daryl. Thanks for putting that in the conversation. So, but their gross profit also went up. So this went up. So I'm like very lenient on their cost structure going up. And I understand that it's not like Apple's doing a bad job. No, the marketplace is just charging more for the inputs. Okay, so that is the reason there. Earnings per share looks real good. Earnings per share growth 18%. Free cash flow $51.5 billion of free cash flow in a quarter. Okay. All right. That's pretty darn good. Their margins are expanding, gross margins. Tiny bit when you're there, you're the size of Apple, 1% means a lot. Profit margin looks great. Free cash flow margin. Look at this bump. So Warren Buffett loves, I guess Berkshire Hathaway, whoever the group of people decided to buy Apple. I think this is part of the reasoning is look at the cash flow these guys are producing. So Apple is, according to analysts, discounted by 14%. Let's take a look at the forecast. So right now we're operating in the fiscal year 2026. It's going to end September 30th, 2026. They're going to be growing at 11%. Looking at the quarter that just ended is right here. We're in a quarter where they're supposed to grow at 12%, followed by 7.7, 9.8. So I think the calendar 2026 year for Apple is going to be prosperous. These are good numbers, real good numbers. And I think for a while, I was critical of the Apple stock, thinking they're not growing. I don't want to invest in a company that's contracting a bit, growing by 2%. I mean, if you're really a good company and your products are awesome, shouldn't your customers want to buy more of them, refresh their products, and more new organic customers are coming to you, buy your product? Well, that now is the story. 11% growth on a gigantic company. That is the right picture for me. The forward PE is a little high, 30.6. It is coming down because they're growing their profits. So I don't think Apple is going to be a huge discounted opportunity, but I think it's interesting. Let me flip it over to Daryl. Take a look at the charts on Apple.
Okay, so I've held Apple for quite a while. I don't own it right this second. Let me just show you. So I first bought into Apple in 2020, and I've traded it many, many times. I've actually closed out my position, but I sold my last tranche right around here. So I got to miss all of this pain, and I've just been waiting. They had, missing the AI boat was a big drag on them. I'm going to show you something here in just a second that shows that may have been a really smart thing in retrospect. So basically, they're right back to where they were when I sold them. The 50-day is moving down. It started rolling over the beginning of the month. 21 days declining. The 5-day is increasing at the moment, but they're basically trading right there. So given the information that I shared just a few minutes ago, Apple, I heard, could be considering eating those costs in their phone release at the end of this year. that they don't raise the prices of the phone. They eat those costs. Apple is not forced into that position because the Apple community tends to be pretty affluent, and Apple could easily pass along those costs. They may take a bit of a hit in some of their sales, but I think Apple could pass along those costs without too many issues. Where Apple users are already paying a premium for every product they buy from Apple, so it's not like people are reluctant to do that or are cost conscious first.
And,
So
and if I
Apple,
could,
go
if I
ahead.
could add in that point, everything's gone up in price. I mean, I go shop for things and I'm like, whoa, what happened? I remember we used to pay like a third of what we're paying for that now. You go to the grocery store, my wife and I were having a conversation. You go buy a few items and you're up to $80 and you're like, geez, man, I used to be like a $20 buy, maybe 30. So back to Apple, it's like, it's not like a universe where everything's going down in price. No, everything's going up. So if you're going to go get that new iPhone and you got a phone 5 years ago and you're like, oh, I paid this amount and now it's 30% higher, that shouldn't be a shock to the system. I think people are going to be like, everything's going up.
Yeah. And I think Apple has a lot of pricing power. So if they do take any kind of a hit on this, I am really considering getting back into Apple. I see their RSI is back above 40. They haven't been above 40 since the beginning of the year. Their PPO, which hasn't been in a buy configuration since the beginning of December, has turned over, and we do have a buy signal on the daily view. Today, we're looking at 2 years, and their accumulation is almost at a 2-year high. They've had a little bit of distribution here lately. But I think Apple might be in a good position this year. I'm going to take a look at a spreadsheet. I'll show the one that I shared yesterday in our call. This one right here. So this looks like looks at the return on invested capital. So look at Apple in comparison to these other big high tech companies. Nvidia is the only one that surpasses them. Then we look at the amount of CapEx compared to their revenue that they've spent. So we'll highlight that one. Amazon 17%, Google 20%. So these guys that are having to build out these big, large language models are having to spend a lot more. Nvidia is also pretty low. Then if we look at the CapEx to the operating cash flow, Apple hasn't, they've been accused of lagging the AI, but they also haven't been spending this kind of money and taking the hit that Meta took 1 quarter ago. They're not spending nearly as much as Google because they don't have a huge data center and cloud environment. Microsoft took a hit just yesterday because of this number.
Yep. And if I could add in that point in particular, so it's strategically, right? Apple culturally, you think about the iPhone. Were they the first ones to put out a smartphone? Nope. They saw that BlackBerry was cleaning up out there, just cleaning up. And they thought, hey, why don't we take that concept and make it better? And they certainly did. Their user interface was a new paradigm or a new innovation that caught the market and took off with it. So they didn't have to figure out, is the market willing to buy a smartphone? No. Our friends at BlackBerry, and you can look at a good string of companies that were kind of proving that out. And then Apple jumped in and took advantage of it. Back to AI. Now that we're seeing, okay, hundreds of billions, maybe a couple of trillion, is going to be spent on AI. Is Apple putting capital at risk? Maybe, hey, you chase down an idea and it doesn't work, and then you're like, oh, great, let's go ahead and write off that 50 billion. Well, that's the kind of risk that Meta is taking and other companies are taking. Apple could kind of look at the situation and say, hey, look, Gemini's in the lead. Gemini's got momentum. Let's partner with Gemini. And who knows, maybe they might be coming out with some new thing, feature, solution that is pretty much kind of going to take the AI capabilities and just present it in a way where it's like, whoa, people really love how you presented it. Back to you, sir.
Yeah, so Google basically pays Apple 18 or $20 billion a year.
That's a big check, huh? You got it right in that number.
Apple is going to take 1 billion of that and pay it back to Google and say, let us use your cloud. This could end up being a genius move where they have just been penalized all year because they're lagging the AI. This could be huge, in my opinion. So anyway, I am thinking about stepping back in here. I think it looks pretty compelling at the moment. Let's look at the weekly. Go ahead.
Well, I was going to say, can you look at like a 5-year chart, like,
Sure.
or just going back 5 years historically? The one thing that I'll tip my hat on Apple is that compared to the rest of the technology space, to me, it's been a fairly smooth stock. It's held its value really well. It has somewhat defied gravity. When it wasn't growing, it still held its stock price. I was probably in disbelief, like, whoa, that's pretty impressive. Back to today, right now, the here and the now, I could see that there's appreciation and trust in the stock because it really has been a sturdy stock. It didn't sell off harshly. It did sell off at times, but not as harshly as some stocks. Like Google sold off pretty hard. And Amazon, it's still in kind of a real low trading range compared to, let's say, the last 5-10 years. But Apple's really been holding on strong to its valuation.
So you know what I'm doing here. If you've ever watched me before, I love these.
I don't, but it looks really interesting.
Yeah, I love these trend channels.
Oh, here we go. We're channeling.
Yep. So we're looking at 20 years worth of data. So,
and the tighter the channel, the better, right?
Oh, that definitely helps. That would definitely help. Then I could make one more copy here, and I'll just put it in the middle, and I'll make it a dotted line just so we can see where the middle. So we're looking at data from 2007 to 2026, almost 20 years. And they have traded up and down within this trend channel. Let me get out of annotation mode here. They're currently trading at the lower end of the channel. But you see over 20 years, they just tend to go up and to the right. We looked at this at Amazon before. We've looked at this. I can't remember. It's been 3 or 4 other companies. I love to see these when they have this channel. You just buy at the bottom end of the channel. Yep. And if they get too expensive, you can do a little trimming. Just be patient, wait for it to come back down and buy it again. So anyway, I love the Apple chart this way, so I'm going to rename this one to Apple 20-year trend channel. I have lots of examples like this, and I can also show you one that's horrible, like Nike, where they had a 15-year trend channel and then just completely fell out of it. So you got to be watchful on those. But when you have these long trend channels, you got a lot of support or a lot of faith in a company, actually. So we'll go back to Apple in the 1 year. Okay, and I actually saved it. So I'm going to go back to daily and just 1 year. And I need to save this one as well. I apologize for, no, I don't want to save it because it'll save over my name. Save as. Okay, there we go. Oh my goodness sakes. Come on, fingers.
It's Friday.
Yep. So anyway, we were looking at the weekly. I don't think I finished that discussion. You'll have to excuse these lines. That's from the 20-year trend chart. Now I need to fix these charts. In the weekly, we're still on a sell signal. So I may watch Apple here, but they do have an RSI that's turning up. We're not, yeah, we are open this morning. So the RSI is rolled over, but the weekly PPO has not yet rolled over. So I may watch Apple today and determine whether I get in today or maybe next week. I don't want to wait too terribly long because I think they're setting up pretty nicely for the next year or two. Okay, that's it for me, unless anybody has
Nice
any
work.
specific questions.
So covering the valuation on Apple, I updated it, and it's fairly priced. It's doing really well. I updated the cash flow and my cash forecast, which improved, growing it by 10%. And I do agree that the company is in a good place. It's fairly priced. Me personally, I would wait for it to be discounted. Maybe 20%, 25 would be better. And then I would definitely consider buying Apple. Previously, I had Apple priced a little too expensive because their cash flows were very different. Before their earnings announcement, their cash flow was substantially lower. As I showed, their cash flow has really improved and their growth rate has really improved as well. So Apple for me is going to be a watch, and we'll see how they do going forward. Thanks for your analysis, Daryl. Market has opened. Looks like Microsoft is rebuilding what it has lost in 1 day. Might take a couple months, might take, I don't know, a year. We'll see. Looks like the software space is, boy, look how small this box is getting. It's getting really small and not a lot of like positive green. The market is down. It's like the S&P was down 0.5%. And telecom's been doing well this week. I've noticed AT&T's been on a rally. That looks good.
Verizon reported this morning.
Yeah, look at that. It's going up 6.46%. Looks good. Chevron's up a little bit. Investors liked what they saw in Chevron. I think they're in a good spot. We can go over Chevron next unless other stocks come up. Looks like Falls Gray wants to look at Duolingo. Duolingo's been getting a lot of attention. It should. It's really discounted. We'll take a look at Duolingo. We'll also look at silver. Shadow Guy has been dodging bullets. He sold his gold ETF, no, his silver ETF. And then silver's been going down. And Mike is, I think, in selling some of his physical silver. Good idea. I was talking to my brother who has some physical silver, telling him he went in and got a quote on his silver, and he didn't think it was good enough. And I I was telling him, yeah, it doesn't seem right because I think he was expecting like a 6x number, and they were willing to give him 2x of what he thought. And I told him he should hang on to it. It seems like maybe the physical gold buyers are not caught up on where silver prices are at. Yeah, so good to see you, Tomas. Anthony, Tony, good to see you. All right, let's keep moving here. So Meta's giving up some of those big gains it had yesterday. It's down 2%. Wow, look at Apple. What is going on? Interesting. Man. Okay. Let's see how that plays out. Okay, so we'll move on from there. So Chevron announced their earnings early this morning, along with Exxon. Both of them tend to announce on the Friday, one of the first Fridays of earnings season, and the earnings were positive. No big surprises. Very efficiently run business. These guys are very efficiently run. It looks like Bo is on. Wants to look at Sofi. Good to see you, Bo. And wants to see, Daryl, what would be a good entry level in your opinion. And I'm going to take a look at Sofi. And I think some other investors are in Sofi doing well with it. So we'll take a look at Sofi. All right. So let's keep rolling here. Chevron. So as mentioned, I think they're a very efficiently run business, and you'll see that they're generating cash flow, profitable, even though oil prices have not been all that great in 2025. And now they're beginning to rise. And the stock's really jumped from mid-December to where we're at now. The stock price has gone up nicely. And over the 1 month, it's up 14%. So that's good to see. And today it's up a little bit. The company, let's take a look at their revenue. I don't think this is correct. I wish it was correct. Boy, the stock would be like going gangbusters, going from 195 billion to 756 billion. Yeah, I'm gonna guesstimate that this is a data issue with our friends over at Stock Analysis. I do have their financials, and we can take a look at that instead. So the price per barrel has gone down if you compare 24 to 25, and especially 22, 23, the price per barrel is pretty high. So this is why their earnings per share was not as good. Let me turn this guy on here, and I can start circling things. So you see that this is kind of gone down, and that's understandable. It's not like, hey, Chevron is operating their business poorly. No, they're doing a good job. It's just, when they sell it in the market, they're going to get a lower price. They continue to drive very good free cash flow. And even though the per barrel price is down, you see that it's actually improved. Their free cash flow has improved. So that looks good. And their international, I think, is going to get interesting because they are the one company that had been in Venezuela, and looks like Venezuela is going to be a reserve that's going to be available to them. So that'll be interesting to see. And I did update my valuation already on these guys. You see that the revenue is actually for the full year. It's not 795. I wish. I think the Chevron stock would be like up 50% in one day. Instead, it's 189. So they are profitable, just very consistent. The oil business has been around for 100 years. There shouldn't be any giant surprises. That is one of the reasons, or that's one of the positives of being a Chevron stockholder is I know what I'm buying. I'm also buying a stock that pays a 4% dividend. That looks good, especially every time the stock market like has a big sell-off. It seems like oil companies, or I should say a big correction like 2022, oil companies were flourishing. And, not hoping for that because overall 2022 was not a good year for my portfolio. But these tend to be a good hedge, a good diversification play against my tech stocks, my communication services stocks, my financial stocks. Energy sits out there, and when everything else is failing, it seems like energy will do well. Looking at my valuation for Chevron. So this one is freshly printed, 22% discount on this business. The stock price has been rising, so there's no giant discount available. And if you look in oil and gas and energy, you could probably find businesses that are discounted at higher rates. Yeah, I think you can, especially smaller caps. Like if I look at Occidental, it's going to be better discounted. But when you buy Chevron, like I was showing you how consistent they are, how well run they are, that's part of the reason why you get a lower discount is there's a lot of investors in it. It's a well-respected stock, and that's one of the reasons why I own it. When I compare it to what I had as a valuation prior to what I had actually a better discount coming out of the October quarter. And I think the stock, as I reset, especially the earnings per share came down. It is 22% discount. I like dividend. I'm going to continue to hold my shares. I'm not buying any more shares in Chevron within energy. I am buying more shares of Occidental because that's a smaller position, and I wanted to build that up a bit. So those are my thoughts on Chevron. Let me kick it over to Daryl to see if he's got any charts on Chevron.
So the last time we looked at this, it's just been quite a while, several months ago. We saw an upward trend channel that we annotated. Then we consolidated, and now we're back in an uptrend. We have a new trend channel. They've been a buy on the PPO since about the 23rd of December. That was confirmed by the RSI being at 50. So we had two signals that were telling us to buy Chevron. And if you had bought it at that point, it'd be about a 16% gain over just over a month. The RSI is getting overbought at the moment. It can stay that way for quite a while. Let me go back a few years and see if not on Chevron, I don't see them get overbought very often. Here they did back in 2017. They got overbought and stayed that way from 7th of September, so a little over a month. Here's the 4th of December to the 18th of January, so a little over a month. Here it looks to be just shy of a month. So they can stay that way for a little while. So I don't panic when they first go into an overbought condition. We haven't had a crossover on the PPO back to the downside. So they're still looking pretty good, and they're in an upward trend channel once more, like they were in the middle of the year.
Thank you, sir. All right, so we're going to take a look at Duolingo. Duolingo is a learning platform, and with the theory the thesis that AI is really going to change software companies, and Duolingo provides, like, you can learn more than 40 languages on this gamified experience. And from what I hear, it's a pretty interesting and enjoyable experience that you would have with Duolingo. Highly discounted. So I look at the numbers and I could very quickly see that, hey, this stock's under severe pressure. And this one here, I think the way that I'm gonna kind of turn it over to Daryl, and really his work is a little more important at this time, because I quickly conclude, whoa, what's going on here? We have a business that's growing at 39%. It's really profitable and generates cash. As it looks forward, the analyst community, 15 of them, think it's 101% discounted. And collectively, as they forecast this business, 26 analysts are putting in their 2 cents on this year's forecast. That's good growth, 22.5, followed by 19, followed by 14.5. So this stock is, if it's going to be disrupted, it's not showing the data, the financials of a company in the process of being disrupted. So this one here, where, I'm looking at it, I'm watching it. Am I an investor in Duolingo yet? At this point, not yet, because I'm not the chart expert. Daryl is, so I'm going to let him speak to the charts. But this has been a real rough road. So Duolingo is a discounted stock. At what point should investors consider this being an obvious opportunity? Let me kick it over to Daryl and see what comments he has on Duolingo.
Okay, we've looked at this one many times, along with some other similar companies, maybe in different solution spaces, but they're still software related. This one's been following a similar pattern. The last time we looked at it, we drew 3 auto support resistance lines, and we may have actually gone back a few more years to actually get these established. So we'll start here. This lower trend line or auto support resistance line, I set at these prices that were pretty stable right around there in 2022. We saw a rise in those prices to about this position, so I drew that level there, and then we found one where we had at least 3 times we found resistance at that line. So these major auto support resistance lines are important to watch. We stepped down into just a 3-year. Well, we'll go in a little bit more. I think I can keep them. Nope, I got to at least stay out 2 years. I have to stay out 3 years to see all 3 lines. So what I said the last time is if it can't hold this resistance line, then you're looking at $100 price target, basically. And I still hold by that. Let's go to 1 year. We've been in a downtrend. I have this red line connecting to as many points as I can. We're trading below that line. We've broken down below this second line of resistance. We haven't had a PPO, an RSI rather, above 50 since the 16th of October. We basically got a sell signal on the PPO in October. We did get a little bit of a head fake here that lasted 2 weeks, but we were in negative territory on this one. And the accumulation has been on a steady decline since the 8th of December. So The big boys are moving out of this one. Money flow is negative. So despite the fundamentals being good, which tells you it's a great company, they manage their business well, the technicals are telling you to get away from this one. Wait for it to return to some positive technicals, because the technicals are just horrible right now.
And what do you need to see in order for you to feel like, okay, the technicals are now saying that this could be a good buying opportunity?
We have a 200-day that's decreasing, a 50-day that's decreasing, a 21-day that's decreasing, and 5-day that's decreasing. You have an RSI that's decreasing. You have a PPO that's decreasing. You need something, one of those signals, to say the character of this trading, this price action, is changing.
Mm-hmm.
Because all it tells me right now, I have six signals, and moving averages are not anywhere near a primary indicator for me, but they're all saying down. All six signals are saying this stock is going down. So I am not going to be the guy running out in front of the car to stop this runaway train. So you asked me the question, what needs to turn? The 5-day moving average is the fastest. It needs to start turning up. We did see it turn up, and it ran up for 2 weeks, but it ended up trending right back down. So that's not the most reliable, but when I'm looking at this chart, if I was just scanning it, if it was part of my portfolio and I was scanning it every morning, I'd want to see that turning up. The 21-day exponential moving average is the second fastest moving average that I have. It is steadily going down. It hasn't seen any rise since the 16th of October. I need to see it start changing and moving up higher. And then you do that the same with the 50. It's a slower 50 days is basically 2 months and a week of trading. Okay. So it's going to be slower. And then the 200-day is almost a year's worth of trading. So that one takes the longest to start turning over. So you'll start getting early signals with the faster moving averages. I mentioned that this one had not been, I'm sorry for this long answer, but I think it's really important for people who are still trying to catch this on the way down to be more patient. So I'm going to draw a line here. Well, these red lines here, this is a 40 and this is at 60. This dotted line in the middle, the RSI, is anything below 50 is bearish. Anything above 50 is bullish. So you can go all the way back to October. It's been bearish ever since October. It hasn't been above that 50 line. And then look how much time it's actually spent below 40. It's been a lot of time there. I need to see, in addition to some moving averages starting to move higher, I need to see this RSI push back up above 40. I'm not going to catch the bottom on that. So if that's your goal, then ignore the thing going up to 40. But I don't worry about catching the bottom. That's basically the bottom of a hamburger bun, which is the bun. I want the stuff in the middle. So once it gets above 40, I'm going to start becoming a little more interested.
Mm-hmm.
When the PPO at least starts getting above 50 or above 0, the midline, because anything below 0 right there is bearish, with the exception of a little bump in October. it has been bearish since June.
Yeah, it's been rough.
It's been rough, but there were a lot of signals here. I mean, we even saw the RSI drop below 50 as early as June. You could have almost gotten out at the highs by following that signal. The PPO actually signaled earlier. If you're more conservative, you wait until RSI is below 50 and you're in a sell signal. That would be more conservative. So I would have taken a little bit more of a loss than if I would have just paid attention to the RSI alone. But this thing's been bearish for months. I mean, I can just, with the exception of a week or two, it's bullish. It's been bearish since June. So I need to see the signals. I love the fundamentals. You shared them. I have it valued as well. I think it's a great company, but the charts are telling me it's not the time to buy.
Yep. Totally agree. Totally agree. All right. So let's move on to SoFi. So SoFi is a new financial services company doing banking, personal loans, a variety of products, and really growing nicely over the last couple of years. And their business, taking a look at it, over the 1 year, the stock is up 48.6%. Over the 5 year, you see this valley. It sold off. It came in with a lot of fanfare and has been going up real well from under $7 a share up to where it's at now. That's a really nice rate of appreciation for investors. And the revenues have been growing at 30%. It's good growth. They're not highly profitable just yet, and their PE ratio is elevated at 44. The reason I think it's elevated is that if we look at the rear view mirror, yeah, this growth is there. It looks good. But when we look at the forecast and start looking ahead, the growth is good, but not amazing, right? 27.5% is good. And next year, 20. Year after that, flat. So I think this is part of the, hey, these guys are not going from, they're not going to keep exploding. It's going to be a good growth company that's relatively small in their space. You know, they're going up against institutions that have been around for a long time. And those institutions have hundreds of billions of dollars of revenue. These guys are a really small fish in a giant ocean that's been around for a while. So this growth has to be more amazing for it to, I think, grab investor attention. The earnings per share is a little low. You know, you got a PE ratio of 40, 28, 27. And if you're going to pay a 27 PE ratio for a company that's just growing 2.5%, that, in my opinion, doesn't make sense. You got to see, if you're going to buy above what the S&P is having as a PE ratio, I got to see a growing stock. I mean, I could buy Apple and it's growing more than 10%, and I know what I'm buying there. So that's interesting to see. When I do my valuation on SoFi, and I'm going to show you my most recent valuation. This is it here. In SoFi, I value like I value banks because they lend money. They lend money and they want to have a net between what they lend at an interest rate and how they borrow, or depositors get paid an interest rate that deposit with SoFi. And when I do that type of analysis, I get to a 22% discount, valuing the company based on its book value and also valuing it based on earnings per share. So I don't see a giant discount on SoFi. I've never been a big SoFi advocate, or I've never seen impressive numbers on SoFi, but investors have made money on it. Financial services, and previously I was at a 13% premium. Right now I'm at a 20%, 22% premium. Investors did well with SoFi, And there's been a string of companies that have come into the space, and those would include Robinhood, other companies that are doing interesting things like Chime. And I think picking the ones that are really truly grabbing market share, coming in with innovation, and setting themselves up to grow really nicely is going to be the trick within financial services with this new generation of companies. I think these are good businesses, but we got to pick the right ones. And SoFi is kind of one of the things that I didn't like about SoFi historically is they're taking on banking. It's like, well, you're doing something that's been done forever. You're doing it better. I agree. You're kind of taking on, I think they were big in student loans. Okay, that's a good idea. But it wasn't new enough for me. It wasn't like, oh wow, people don't invest that way anymore. And I've always compared SoFi to Robinhood because they kind of came out around the same time. Robinhood, on the other hand, they came in with zero cost trades, changed the industry, just put the establishment on its heels. Like, whoa, what do you mean zero cost trades? Yeah, now everybody does zero cost trades. They were big on crypto early. And they just keep doing things. Now they're in prediction markets. Well, prediction markets, I don't know that they existed 10 years ago. I had never heard of them up until maybe a couple years ago. And they've become really, really interesting now. Well, Robinhood's all over that. I like that kind of innovation and disruption. And I don't know that SoFi is keeping up with that type of massive kind of disruption that's going to continue to enable them to grab market share. And I think Robinhood is doing that really well, which is why I hold the Robinhood stock. So that's my review of SoFi. What do you think of SoFi, Daryl?
This is not one that I own, but I'm looking at auto support resistance that I'm just going to put right there. That was based on 3 years worth of data. They have traded quite a bit above that, got pretty extended from their 200-day. The 50-day was increasing, the 21-day was increasing. All this looked pretty good. I was getting a little bit of a warning signal right here. So whenever you see prices going up like this, but you see RSI levels that are going down, PPO levels that are going down, that's a cautionary flag that things could turn around in the not too distant future. And we can actually see that it is indeed starting to do that. So we had some early warning back here. Those are things I watch all the time on my holdings. And we discuss it quite often in these live streams as well, that you at least got to be aware that these things are in place and get more cautionary as this happens. So even though they've been trading way above their 200-day moving average, I see a 70% there. I see 79% there. They're finally coming back towards their 200-day moving average. They're only 13% above it at the moment. So the 200-day has moved up to catch up to the pricing, but you can definitely tell the momentum is starting to come out of this one right now. 50 days turned over, 21 days turned over. They're trading below the 5-day moving average. We got a big red candle here that's engulfing the previous day's candle. We have an RSI that's below 40, nearing oversold territory. We've been in a sell signal on this one pretty much since the 29th of September. The accumulation had peaked out back in December, early January. It is starting to get into distribution mode. So I expect this one to probably break through the 200 and possibly get back to this auto support resistance level of around 17.
And so, do you have an opinion on what would be a good entry?
I let's see. If I were interested in this company and I were buying it, I'm a patient individual. I can wait months to buy a stock. I don't have to buy it today. I could wait for that 17. I think that's a good entry point. It has had good support there over time. I think they've run up above their value. Let me look at fast graphs real quick. And by the way, Duolingo is trading below their fair value at the moment, and that is good. But the technicals aren't supporting that at this time. So we'll look at Sofi. So you can see that they're overpriced. So they've been growing. This is at the max time frame, so I only have about 6 or 7 years worth of data here. Probably 4 in the back and 3 in the front. They've grown at 16.5%. So that's their fair value ratio that's going to be used. They should be trading around $6. 1 year out, they should be at about $9, but they're trading at 24. So they're overpriced, in my opinion. If they keep trading at their normal market multiple, which is the blue line, then, they really should be trading around 20 right now, 31 at the end of next year.
And if I could add there, like one of the characteristics of SoFi that I haven't liked is that they don't make a lot of money. They're not very profitable. And that's what's showing up here is if you compare them to its peers, right? Like the buy now, pay later companies are more profitable. Robinhood's more profitable. So within financial services and looking at the new generation companies trying to make some noise, you gotta keep an eye on how profitable is that business? Is it worth having? And in this case here, I agree with this conclusion, which is if you look at the earnings per share, if you look at how much money they get to make on their revenue, it's not very much. And other peers do much better.
So there is another company in this space that I'm looking at a lot. In fact, I actually own the other company. It was founded by this same guy that co-founded SoFi. But this other company, they do similar things to SoFi, but they don't keep the debt on their books like SoFi does. So when SoFi makes loans, they keep it on their books. This other company, they put that into a pool and they sell that to investors on their blockchain.
Mm-hmm.
And it is a brand new company. They just IPO'd this year. I am not a big proponent of IPOs, but I like this other company's prospects because they're very similar to SoFi, but I think they're doing things a bit smarter.
Yeah, and it could be very disruptive. If that
Yeah.
really works, the banking industry is going to be on its heels. So
Yeah, this other company, and I did a video on it. If you want to take a look at the video,
what was
I
the name of
like
that
the
stock?
FIGR, Figure Technology
That's
Solutions,
right.
founded by the same exact person. So very experienced in this space. They don't hold the debt on their books. They have everything on the blockchain. They can do HELOCs, get them approved and funded in about 5 days, where a traditional bank would take about 45 days. So they've implemented the technologies that can go through the approval and funding process incredibly quick. They can do mortgages, and they sell those mortgages off. They put them in those pools. people can invest in those, and it's basically like a high yield savings account. So no, I like what they're doing
Yeah.
a little better than here. I think this opportunity is just extended at the moment.
Yep. Agreed. Both. Thanks so much. Good to see you again. Really appreciate the super chat sponsorship. Taking a look at where we are trading, we're still down a bit. Not a lot of green spots. It's kind of a mixed market right now. It's not terrible. Are we going to rally into the afternoon? Maybe. Seems like we opened lower, but some spaces like Verizon's having a great day. They've underperformed. Verizon's underperformed AT&T for a while, and when I value Verizon, it shows that it's a pretty good idea, especially if you're a dividend investor. Today's a tough day to buy it, though. It's up almost 8%. The software space is licking its wounds, trying to form some type of comeback, I guess. But boy, these boxes are getting small. And Charles Schwab's doing, Robinhood is flourishing. And Tesla's moving higher. Chevron's doing fairly well today. Okay. The GE companies are doing well. Lockheed had a great day yesterday, and it continues to go higher. Very good. All right. Somebody requested we take a look at CVS. This is the big healthcare company. They predominantly do the pharmacies, and the pharmacies drive a lot of prescription sales, but they attach a convenience store to their pharmacies, and the convenience store drives pretty good margins on that product. And I know that they have, every time I walk in through my local CVS, they have like makeup and all that kind of like the typical consumables. Oh yeah, I need to get toothpaste. Well, they got that for you, and they have snacks, and they even have milk. They have certain perishables too, and of course they have. They bought Cigna some years ago, so they're a healthcare insurance company, and they also are providing some healthcare services at some of the locations, similar to like a urgent care or doctor's office kind of model. So the stock had been doing quite well. It's still doing okay for the 1 year, up 29%. But it really had a rough day when it was announced that the government's going to hold the Medicare premium, Medicare Plus, I guess, the supplemental Medicare insurance that people could buy. It's going to hold those rates close to flat versus allowing that 4% increase. And that really does take revenues off the table for health insurance companies. So it really did dive down quite a bit. The company has been growing. This has been a company that is massive in size, big revenue level, and it continues to grow. It's going to announce in mid-February. It's been growing, I think, very impressively, because this is a big number to grow on. You're adding close to $8 billion of revenue on top of the income statement. That's really good. They have lower margins because they are selling pharmaceuticals and stuff like that. But their profit margins, if they can make a little bit of money, a little bit like Costco, they just really crank out very good cash because their size is so darn big. For a long time, this was a really, really good stock. And healthcare has been kind of in a rough 3-year run. Healthcare hasn't done all that great. United Health has done terribly. Other healthcare stocks have been roughed up. At some point, I consider it being an opportunity. And I'm glad that I bought shares of CVS. I'm sitting on a good gain. But what do I see ahead for this stock, right? Looking at the forecast, we have analysts saying it's discounted. And FYI, they pay a nice dividend. So this is a good dividend payer, 3.6%. That looks good. And analysts think 26% discount. And when we look forward, this year is going to be a little hard to grow. I mentioned the government stepping in and saying, hey, we're not going to allow the health insurance payers to grow a particular category of revenue. They are going to have a little bit of growth. They are going to grow their profits. And then 2027, better growth in 28, flat 29. And their profits will continue to rise, bringing down their PE ratio to a single digit. Next year, it'll be single digit. Geez, that's low. So I'm going to keep holding my shares of CVS. I got no reason to sell. I'll collect that dividend. It's been a good appreciating stock for me. So showing my valuation of CVS, it's a nice discounted stock. I'm somewhere within range of what analysts are thinking. They're thinking 26. I'm thinking 30. And I'm collecting a dividend. I'm good holding my CVS shares. And I'm not buying any more healthcare shares right now. I'm a little shell-shocked with what happened to United Health and CVS. They're good investments. Over the long haul, I'm going to be fine. But it just has been a rough time here at healthcare. But that's my valuation of CVS. What do you think of CVS, Daryl?
I think they're still set up pretty nicely. I have this trend line that we had connected to the February low, and then this low that we just saw recently passes through an area where we drop down below it. But I think generally the trend is up. It kind of matches the 200 day as well, which is still moving up. 50-day looks like it could be rolling down a little bit. The 21 days coming down. I don't think we're going to see this, blow out to the downside anytime soon. We did get a short-term sell signal in the daily view on the 27th of January, but that just matches up with the announcement. Let's take a look at the weekly view. So I think this one overall still looks pretty good. We look at the weekly view. We've actually been in a sell since the 3rd of November. So basically we've traded sideways since November. It is going down a little bit. We're getting to an RSI of 50. If you're a long-term holder, I think you're still good. I think CVS will be just fine. In general, I think throughout this current administration and depending on the next administration, healthcare could just be a tenuous sector to be in for this kind of stuff, especially if it involves Medicare and Medicaid and government funded programs. It could just be challenging in the next couple of years.
Yep, it definitely could. All right, so let's move on. We're going to look at Newmont, and then I put MPW. Mike wants to look at MPW. We can take a look at that. So Newmont engages in the production exploration of gold properties. It also explores for copper, silver, zinc, lead, and other metals. Look at that chart. Man, that looks nice. It's having a down day today, but geez, what a chart. So the 5-year kind of shows that, man, when things are off for Newmont, boy, the stock really sells off. But when they're on, boy, are they on. 188% rate of appreciation. Market cap's gotten up to 129 billion. Forward PE looks pretty sensible at 14. They pay a small dividend. It's priced too high, according to analysts. And Newmont has been benefiting from the high commodity prices in gold, silver, copper, and so forth. So they have flourished. They've been able to sell their materials at a much higher price, and that drives higher profits. Look at the profit jump. Really jumped higher. And it is, and I don't know the answer to this question, but how long do commodity price rallies last? Like around silver, copper, gold? That'd be an interesting question. Maybe I'll ask Gemini that. Because that's not going to give us a perfect kind of setup. Like, oh well, the average silver gold rally lasts 3 years, so you're like, all right, cool. I could set my watch to it. No, it's going to give us a sense of what's happened in the past, but this occasion it could be shorter, longer, and so forth. But it'd be interesting to look at. All right, so this stock's just looking fantastic because it gets to sell its commodity, its materials for a higher price. No, you don't need an economics degree to figure that one out. And its earnings per share has flourished. So the fundamentals look fantastic. But it's all dependent on that commodity price. I have a valuation on Newmont. It's if I look at and I think I put in the wrong symbol. If I look at the data, make my best estimates, it's a 7% discount. And that's just not enough for me to jump in. Because I feel like if the bottom falls out of this, boy, I'm sitting on a 30-40% loser. How much higher can it go? I don't know. But I'm thinking there's a higher likelihood that I could lose money versus make money. And if I make money, I mean, this trade is not early. It's not like, whoa, this thing could begin to go and then it's going to go up high. No, it's already gone high. Can it go higher? It could. I just would rather stay away from this one. Newmont's been an absolute winner. So let me kick it over to Daryl, and I'll ask Gemini how long these gold and silver rallies usually last. Over to you, Daryl.
Yeah, so a little bit of a sell-off today. We're trading about 52% above the 200-day, which is increasing. The 50-day is increasing, trading right at the 21-day, which is increasing. The 5-day is starting to roll over because of the downdraft today. This one's kind of interesting because we had prices going higher, and notice the RSI was going higher too. PPO is also going higher. So even though we did have a little bit of a pullback here, this was telling me that the run wasn't over. It's not like we had a negative divergence. We had momentum supporting the price. So even though we had a little bit of a pullback, if I was in this one, I wouldn't have worried about it too terribly much because I see a lot of momentum back here. So that's one where we have a convergence of RSI and PPO on the price. Okay. We are overbought. We're coming out of overbought territory today, getting a little bit of a sell signal today. This is probably based on the new Fed chair being announced, the candidate being announced. So that's going to put pressure on gold prices possibly. I don't know what the dollar's doing today. So we are getting a little bit of a sell signal here. Let's look at it in the weekly view. We're still on a buy. So if you are inclined to own this one because of the support of the RSI, I mean, look at this. I mean, this is just still keeps going up. This one could go higher, even though we're having a bit of a sell-off today. Just keep your stop losses pretty tight on this one because they can change on a dime.
And I asked Gemini, hey, how long do these rallies in gold and silver prices last, and looking at historical data, nearly 3 years. So it's not like these things kind of go 3 months and then it's over. These things tend to stick around for a while. And how long has Newmont been in rally mode? Let's take a look. So they've been in rally mode for a little over a year, depending on where you start to measure. Yeah, a little over a year. So there may be some time left on Newmont, judging from historical trends, things that have happened in the past. I like hearing the comments from Daryl.
One of the things that I heard this morning as well is it's not like a supply demand issue that Apple may have. They may have a short-term burst in demand and their supply may be constrained, but they can add capacity and fill that supply pretty quickly.
Mm-hmm.
With gold, they only make so much gold. It's not like you can just go out and increase capacity. So as
Right.
long as the demand stays high, it's not like supply can fill that gap very rapidly. And that goes with silver and some of the other precious metals. So
Yep.
as long as this demand stays where it is, you can expect these prices, I think, to continue.
Good point. All right. As the world turns, looks like I'm seeing a little more red. Meta's still down, but that's where we're at there. All right. Mike wanted to take a peek at MPW, which is a battered real estate investment trust. What has it been doing? It's up 13%. It's been, a rough road for investors. It's really sold off. They got caught up in, I believe, leasing out space to a tenant who went bankrupt, and that really just created a lot of problems for this real estate investment trust. Let's take a look at their business. How have things been going recently? And what's wow, their revenue's really grown nicely. That looks good. But rental total revenue. But I'm not seeing. Okay, let me look at the quarterly. That's the second time just today that Stock Analysis, their data has been a little unusual. Looks like the most recent quarter, these guys are growing their revenues by 10%. That looks good. This is a higher risk, lower quality real estate investment trust, but it's a small cap. You would think that these guys are in the type of a business, they lease out medical properties, hospitals, that type of thing. And those are just a necessity, right? We need hospitals. We need medical, offices for the doctors that we need to go see. They pay a high dividend, so you're getting paid well on your dividend. If you invested a year ago, I mean, you got to be satisfied. You got a 13% rise in your stock, and you got paid that dividend. It's pretty good money, pretty good darn money. Over the year to date, not bad, down a little bit, but stocks in healthcare are down quite a bit. So that looks okay. Let's take a look at some other things. So the growth in the current quarter looked decent. 4 analysts are covering it. They think it's discounted by 18%. Real estate investment trust, I value using their earnings per share. And I want to make sure they can pay the dividend too. So looking at the year that we are in is 2026. Looks like they are going to grow their revenue They're going to be profitable. That's good news. They're going to carry a high PE ratio because they're just getting back into the profit zone. And then next year, 27. So it looks like the business is trying to get it on solid footing, and that would be good news. I'm not seeing a big discount. If we look at other REITs, I think they offer better PE ratios, and it's not a perfect match, but it's a REIT, and they don't do strictly healthcare. They're more of a long-term living for typically an older person that needs some health attention. And these guys are solid. They've just been going up. And this year you're paying a 22.77 PE ratio. So do I want to pay 27 for, and actually this year 46 for a troubled company? No, I don't, but maybe other investors do. It's gone up a little bit, which is good. Now, I don't know that this is going to give me what I want, but let's give it a ride. So dividend per share. And here we need to match it to funds from operations. And that's what I thought. I didn't think that was going to give me what I needed. So let's take a look at. So it's not giving me funds from operations, but you got to match up to funds from operations. I should be able to find that on their website. So I'll take a look at that and just make sure that you got the dividend cleared and you understand what kind of dividend forecast you can put in, in your process. Let me kick it over to Daryl, and I'll try to find that funds from operations while he looks at the charts.
Yeah, we can look at it here in fast graphs as well. Yeah, so their payout ratio is underneath their funds from operations. So they have it covered. It's a little close at the moment, but because they've cut their dividend several times, so the payout ratio is lower than it was before. So their funds from operations are covering that. Okay. This one has been pretty much traveling sideways since the end of 2023. Occasionally it acts like a meme stock and runs up real fast based on no change in the fundamentals. So it does act as a meme stock sometimes, but they pretty much been sideways after. I'm looking at 5 years worth of data. You can see where they were trading before all the drama started with the bankruptcies and what have you of that hospital operator. So they've been going sideways. Here the last, let's just step into 1 year. Here for the last year, they are up from a year ago by about 21%. They reached a low in August. We started getting hopes of rate cuts that drove them up higher along with most other REITs. And then we've plateaued at this price. We've gotten 3 rate cuts so far, and now we're on pause. So this one could just trade sideways for a while until we have a new Fed chair announced today. And by the way, if you want some additional information on him, Victor, I do have it collected where we could just do a quick review of the new Fed chair candidate, see where he stands on things. So anyway, that's going to come into play. We'll just have to see what happens with the FOMC drama this year.
Yeah, and I found the funds from operations, 40 cents per share. They're paying out And that's for 9 months, and they're paying out 33 cents. So that dividend seems to be okay. It seems to be safe. So the new chair coming in, he's going to take the job in May, or is there a timeline?
Yep.
Okay.
I can cover that real quick if you want to. If anybody's interested, I don't want to bore anybody.
Is he a socialist and he's going to like just kind of eliminate the stock market?
So Kevin Warsh was officially nominated this morning. Jay Powell, his term expires in May, and the selection was announced this morning early. I was watching early market action, and generally the futures had kind of bottomed out. When this announcement was made, it did start making some progress higher. So I think the market is okay with this particular selection. It does mark a pretty significant shift for the central bank as they're looking for a leader more aligned with the administration. He is a 55-year-old gentleman, been on the Federal Reserve Board of Governors from 2006 to 2011. He was the youngest governor in history when he was appointed at 35 by George W. His current roles, he's a fellow at Stanford University and a partner in whatever that name is, family office. He did have a little bit of a reputation during the 2008 financial crisis. He was often viewed as an inflation hawk, frequently warning about rising prices and expressing skepticism towards aggressive quantitative easing.
That's good.
So that gives us a little bit of a background on what his thinking is there. So President Trump cited his experience and personal familiarity. Their families are familiar with one another. I don't know if they're great friends, but they are familiar with one another. So he's been historically hawkish. He has signaled support for lower interest rates recently. So that's kind of a divergence from his past thoughts. He's aligning with Trump's desire to be a little more dovish on the monetary policy to stimulate growth. There's concerns about the Fed independence, but he may be open to more coordination with the White House. So there's concerns about that. Warsh is also big around AI and the productivity that could bring into our economy. So he is a big proponent of that and has made several talks and discussions on that topic. So, Jay Powell is more data dependent. Kevin Warsh will probably favor lower rates on AI driven. The balance sheet, you can see the differences there. Kevin Warsh actually is more aggressive on the trimming side. So on innovation, he is a big pro AI and market driven stuff.
So let me, if you can go back a slide. So I was thinking through the whole independent stuff, right? And so the chairman of the Federal Reserve, he usually goes and he listens to he is questioned by Congress. Okay, that's part of the job. Is you go to Capitol Hill and then some committee will ask you, oh, well, what are you seeing with regards to unemployment? How are you doing this? How are you doing that? And then the chairman will answer questions or kind of explain what they're seeing and what they intend on doing and so forth. For me, that's a form of influence. If you have a conversation with the Fed and you get to ask your questions, in the question is your influence, right? So am I like out in left field or
no?
Does that make sense?
No.
And I guess the White House doesn't get that type of dialogue, but Congress does.
Yep.
Okay.
Senate.
So that's the Senate. Sorry.
Yeah, the Senate is the one that does confirmations.
All right. So
I'm going to talk about that on this next slide.
Actually. Oh man, go ahead. Keep going.
So he still has to go through Senate confirmation. So he is just a candidate at this point. And this could be a pretty intense. It depends on how much they want to question him about his ability to resist political pressure, because there is a lot of concern about independence. Then the other big issue is, does Powell stay on the board? He wouldn't be the chairman any longer, but his term actually runs through 2028.
Mm-hmm.
So that's going to be some other drama that we'll face in the
So,
FOMC this week.
so okay, let me make sure I understand that because okay, so he could still be a governor, which
Yep,
I don't know how many governors there are, but he could
11 or
still
12.
okay. All
And
right,
then
perfect.
8 of them are voting at any one time. I think some of them are permanent voting members, like the New York Fed,
Right.
and then some of them rotate for any given year.
Yeah.
I can
Okay.
also say that Kevin Warsh was actually a candidate in 2017, so he was beat out by Powell
Mm-hmm.
then. So he's got a pretty long history
He seems like a
related.
solid guy. I think he'll do a
Yep,
good job.
yep.
All right.
So
Perfect.
anyway,
So
I thought that was interesting to cover quickly because it is going to affect markets. Normally, when you get a new Fed chair, somebody or the markets are going to test them.
mhm.
So we can expect some volatility around the Fed actions for the rest of this year.
Well, so far the markets are they're not disturbed by it. Well, looking at his qualifications, it's like, geez, man, that guy seems pretty solid. So
Yep.
I don't know that this has anything to do with the nomination. I think this week's been rough. Just ask Microsoft stockholders or software stockholders like myself. And it's been a rough week. All right. So, speaking of which, let's take a peek at this VIX. We're at 17. Can you interpret that? Where are we in the kind of like the fear index?
So a VIX of around 17 implies a 17% annualized percent volatility over the next 30 days. So
Over
that's
the
what
next 30
VIX,
days.
yes, and the 17% relates to an annualized change in the S&P 500 over a year. So it's a smaller percentage over 30 days, but annualized, you can think of it being 17% volatility.
Got it.
So 17 means that the market it's a place to be getting cautious. If you want to look at my screen, I have it actually pointed out. So I have a line at 17, and that's arbitrary, but it seems to hold pretty well. When you get to 17, you start getting a bit of caution into the market. When you spike up anything above 20, there's significant fear in the market.
Mm-hmm.
Okay, so you can start seeing some pullbacks when it spikes up above 20, and if I had the S&P on here at the same time, we could see those. 17 isn't horrible, but you'll notice we've been on a steady decrease since the 24th of December.
Good chart. So the
One
last
other
time we
one one other one that we can look at that'll help put this in perspective is the other one that I show quite frequently is the S&P along with the CBOE put call ratio.
Mhm.
So this tells me the gray lightened data in the back, that's the raw data. And then this darker blue line is a 5-day average of that raw data. When we start getting above 55, that means there's the ratio is skewed to puts, so people are getting cautious and buying puts as insurance against a downturn. So when that starts getting up high, then puts are really being bought. That usually tells you, when it does that you're kind of at the bottom of the market, the bottom of a downturn. So anytime you see these big spikes, people kind of wait till the last minute to buy insurance. So here we had a big, huge spike. It took 2 more days for us to hit a bottom. Here's a big spike. We were almost already at the bottom, 1 additional day. Here we were at a spike. We had 1 additional day. So when you see these big spikes like this, you have a good indication that you're at a bottom on the S&P 500.
Good stuff, Daryl. Thank you. All right, the markets are a little higher than where we started trading. It might just kind of ride off into the sunset, being the last day in January. And the heat map, see what's going on. Seeing a little more green. Looks like Nvidia is going a little higher. Google's, maintaining its stock price. Chevron's having a good day. Good to see. Man, look at Tesla. So I guess people are pre-ordering their robots. And man, look at Verizon. Go Verizon. All right. Somebody asked about LendingClub. This company's been around for a while. They operate as a bank holding company, provides a range of financial products and services in the U.S. It offers deposit products, including savings accounts, checking accounts, certificates of deposit. Okay. And they do consumer loans, and they used to do like peer-to-peer loans, like somebody can lend somebody money on the platform. So they're classified as a regional bank. And man, they really had a rough day, huh? Did they announce?
Did they report yesterday?
They announced on the 28th.
Okay.
So Wednesday. And it did not go well.
Must have been after the market, would be my guess.
Yeah, they're on the West Coast, so
okay.
It's been a rough couple of days for investors. It's up a bit, but let's look at the 5-day. It's down 21.6% over the 5-day. So it's been a rough situation. So its growth is, you could say, slowing. Man, these numbers are kind of unusual. Oh, no, that's okay. That number's fine. Okay, so 12% growth for a small regional bank is okay. It's just not impressive. And the earnings per share looks okay. So they're operating with gross margins, huh? Not interest margin like a bank. So I'd want to see like their actual financials to see how they classify themselves. A regional bank shouldn't have a P&L that looks like that. It should have net interest margin being the beginning of the income statement. So this is likely the problem. Contraction in the forward 12 months. Yeah. That is rational. That's a rational sell-off. Because they're small. It's like, why are you not growing? People don't like your products. People don't want to do business with you. That's a big problem. I wouldn't want to buy into a stock that's under this situation. And they haven't had consistent growth either. They were growing really well in 21. 22 was a good year. And then contraction, flat, growth, contraction. Yeah, it's not my cup of tea. And I'll leave it to somebody else. This isn't gonna, I mean, this could be kind of a swing trade for anybody that wants to try to predict where it's going from here. I mean, that was a pretty good chart in the making. It was having a good year. But this to me is I need to stay away from this stock situation because this has happened on 2 occasions where growth and then they contract. It's like, whoa, this is not a durable business. They have a good year and then they go away. I don't want to be a part of that. I don't want surprises that cost me a lot of money. And I think that's what investors are experiencing at this time. They are 21.5% less wealthy in their investment in LendingClub. So I would want to stay away from a stock like this. I just don't have any confidence in it. What do you see in LendingClub?
Okay, so we're on a 10-year chart here. I wanted to find out where their quiescent price is, and it looks to be about where I have this line, so right around $16. They were trading right around there, here, and they got up to it a couple times here, traveled above it, and recently tested it as resistance here in beginning of 2025. So we'll step into 1 year, and I have this trend line. Let's go see where that actually starts. Okay, it starts in November of 2023. I didn't use the April lows this year because of the tariff stuff, but it tested it twice here, and I think it's probably still in play. So that tells you why I have the trend line there, and it's going to be important in the rest of this discussion. So they did drop below the 50-day, which had been rising and is now flat. 21-day taking a hard dip. Remembering that this price is 120, one of the 25 points in the daily price action. So it's going to have a big effect because it's such a big drop. All of these were pretty similar, so the average was continuing to rise and stay steady, but it's going to take a big drop today because these two are replacing the prices from 20 days and 21 days ago. So that's why it's turning over right now and turning over pretty hard. So it's just barely above the 200, about 7%. It's right at that auto support resistance line. You have the 200 here, and then you have this trend line. So we'll have to see where it goes over the next week or two. If it breaks down below the 200, then this trend line, I think, is going to come into play. The RSI did get down to 30 yesterday. It is moving a bit higher. The price is a bit higher than the low yesterday, although earlier in the morning it had dropped below yesterday's close. So it does look to be picking up a little bit this morning. We did get a sell signal a couple days ago on this big price drop, and while the accumulation went into some serious distribution the last 2 days, money flow is negative and looks to be getting a little bit worse at the moment. So either the 200-day or this trend line, I think, is going to be in play here within the next week or two.
Nice work. Thank you. All right. So we covered all the stocks. Good stream. Thank you very much. And looks like the market is pretty much where we left it. Looks like Tesla stockholders are happy today. Broadcom, Micron, Nvidia are a little higher. The telecom stocks are flourishing. Guess some investors are going to a safer asset class or industry, and that telecom industry tends to be a safer industry. Staples are going higher. So I think we're going to ride off into the sunset here for January. Stock market isn't too bad. And we'll see what February has in store for us. We've got big earnings next week, huge earnings. We've got Google announcing, Amazon, and a bunch of other companies. So next week is, I think, the next big shoe to drop. And I think that's going to kind of establish how we're going to trade around tech, communication services, and we will see how that goes. Any departing thoughts, Daryl?
I can take a look at one more page here because I've been showing it to you guys here the last few streams. I like to keep track of the earnings as they're coming in. So these companies, and I don't expect these to mimic your holdings, but they do kind of reflect the overall market. So revenue for these companies that have reported so far has been up 1.13%. The earnings have been up 3.75%. We can look over here and see what was the initial reaction. So most have beat or were in line. So that's almost not 80% have either beat or been in line. But we're only getting positive results on 30% of the responses have been higher. It's been on the negative. It's been about even there. So I kind of like to do this just to kind of keep track on what the market reaction is overall. Because last quarter we had a very similar where we were beating, but they weren't getting rewarded very well.
Yeah.
I can look back to other quarters using this kind of format and I can see, okay, they beat and they're getting good responses. So I like to keep track of it just so I can kind of set my own expectations on what the market, how they're reacting to, the earnings at any given time.
Yeah, good stuff. All right. Well, that is it for our stream. Thanks so much for tuning in and for requesting the stocks that you listed. Good luck with your stocks today. We'll be back next week. We'll have plenty to cover next week. For now, everybody have a good day, and we will talk with you soon.